We picture the world of high finance as this, you know, perfectly oiled machine. Like, we imagine it driven by supercomputers, algorithms, and people in tailored suits who just possess some kind of crystal ball.
Right, the Wall Street stereotype.
Exactly. We see the talking heads on financial news networks shouting about buying this or selling that, and it can just feel incredibly overwhelming.
Oh, completely. It's designed to be intimidating, honestly.
It really is. But how do the pros actually decide what a stock is worth? And maybe more importantly, how do they legally piece together hidden clues about a company's future without, committing federal crimes?
That's the real question, isn't it?
Yeah. So today we're doing a deep dive into a professional training manual, specifically the NISM, the National Institute of Securities Markets Research Analyst Workbook.
That's a fantastic source.
Right. We're focusing entirely on Chapter 4 today, which covers the absolute fundamentals of research. This is the exact material used to train certified research analysts.
So we're stripping away the hype and looking at the actual mechanics.
Exactly. Just laying out how investment research is actually conducted.
Well, it's a fascinating manual because right off the bat, it forces you to abandon the casual terminology that most people use every day.
Oh, yeah. I noticed that right away.
Right, because before you can even begin to analyze an asset, the text basically demands that you define the specific game you're playing. I mean, people constantly use the words investing and trading interchangeably.
Like they're the exact same thing.
Exactly. But the workbook draws a really hard line between the two. And it separates them not by the asset being bought, but by the intent, the time horizon, and the underlying mechanics of the actual decision.
Right. So the manual defines investing as an upfront commitment of money based on a really rigorous foundational analysis.
Yes, rigorous being the key word there.
Yeah. You aren't just buying a ticker symbol. You are evaluating the safety of your principal, the income the asset might generate, and its long-term growth potential.
You're looking at the actual engine of the company.
Exactly. You are essentially marrying the underlying business, believing it will generate cash over years or even decades.
And that is the core of it. The investor cares about the intrinsic value of the business. Trading, on the other hand, well, it operates on a completely different set of physics.
Okay, how so?
A trader is really focused on earning a profit on the spread. So that's the difference between the buying price and the selling price.
Right.
They aren't necessarily concerned with what the company actually does or, its long-term cash flow. They are motivated by historical price patterns. They're basically looking to catch a short-term wave over hours, days, or maybe weeks.
So if I'm getting this right, the investor is buying the farm to sell the milk for the next 20 years.
I love that analogy, yes.
But the trader is just trying to buy the deed to the farm today and then flip it to someone else for a higher price tomorrow based on local real estate momentum.
That captures the time horizon perfectly. It's a completely different mindset. And the manual actually further divides that investor camp into active and passive strategies.
Okay, passive being like index funds.
Exactly. A passive investor is essentially admitting, hey, I cannot beat the collective wisdom of the market. So they allocate capital to a broad asset class and just accept the average rate of return.
Which is totally fine for most people.
Right, absolutely. But active investing is this constant, aggressive hunt for mispriced securities. The active investor is searching for moments when a stock is priced below its true intrinsic value so they can buy it, or above it to sell.
Which requires an enormous amount of information.
Mountains of it.
And that brings us to the actual job of the research analyst. The workbook breaks this down into a two-step process, right? Gathering the data and then analyzing it.
Yes.
Okay, let's unpack this. The data gathering part is where the lines can feel, a little blurry. Analysts are out there visiting supply chains, talking to vendors, digging through local records.
It sounds a bit like espionage.
It really does. I have always wondered how they legally skirt the line of insider trading. If an analyst finds out a company is doing well before the public does, isn't that cheating? How is that not a crime?
Well, the distinction lies in the exact nature of the information itself. Gathering non-public, price-sensitive information. That is illegal insider trading.
Right, so the big secret tip.
Exactly. If a CEO pulls an analyst aside at a dinner and secretly whispers, hey, we are filing for bankruptcy on Tuesday. Right. Acting on that is a crime.
Because it's a sure thing.
Right. It is a material fact just handed over on a silver platter. But the industry actually operates legally on something called mosaic analysis.
Mosaic analysis, I have heard that term.
Yeah, so instead of getting the final picture handed to you, you are gathering tiny pieces.
Okay, let's frame this around data triangulation for a second. It's like tracking a delivery truck, right? Seeing a company's delivery truck on the highway. That's public information.
Completely public.
Knowing the location of a specific warehouse is public, but an analyst might track the frequency of those trucks arriving at a facility, combine it with, I don't know, a spike in local hiring advertisements for forklift drivers.
Yes.
And then they cross-reference that with a totally public report about increased consumer demand in that specific sector.
And that is highly prized detective work. Individually, none of those data points, the trucks, the job ads, the industry reports, none of them are illegal, price-sensitive insider tips.
Because anyone could find them if they looked hard enough.
Precisely. But synthesized together, they form a mosaic. The analyst uses these seemingly insignificant edge pieces to deduce, well, a massive surge in production before the quarterly earnings report is ever even published.
Oh, wow.
It requires immense analytical rigor to assemble a clear legal insight from all those disparate fragments.
So once that mosaic is built and they have this picture, the analyst has to decide what to actually do with it. How do they look at the market to make a move?
Well, that's where things split.
Yeah, the NISM workbook divides market analysis into two entirely different, honestly almost hostile philosophies: technical analysis and fundamental analysis.
They really don't mix well.
Let's start with the technical side, the chartists. What's their deal?
So technical analysis ignores the underlying business entirely.
Wait, entirely? They don't look at what the company sells?
Not at all. According to the text, chartists focus on three essential elements derived strictly from historical market data. First is price history, which gauges the direction of the asset.
Okay, is it going up or down?
Right. Second is trading volume, which measures the underlying strength or like the conviction behind that price movement.
So if price drops but volume is really low.
It might just be a blip, but if it drops on massive volume, it is a trend. People are fleeing.
Got it. And the third?
The third element is the time span over which these movements occur. They map all these elements onto charts to find support and resistance levels.
Support being a price floor where a stock historically doesn't drop below, right? Because buyers see it as cheap and rush in.
Yes, exactly.
And resistance being a ceiling where sellers historically take their profits and push the price back down.
Correct. But the foundational assumption of technical analysis is really what defines it. It relies heavily on the efficient market hypothesis.
Oh, the EMH.
Right. Technical analysts believe that all relevant information, the company's fundamentals, the macroeconomic environment, current market sentiment, it's all already instantly and fully reflected in the stock's current price.
So everything is already baked in.
Yes. Therefore, reading a balance sheet is a complete waste of time to them. They believe market activity alone generates indicators that forecast future movements.
Okay, here's where it gets really interesting, because the manual seems to present a massive paradox here.
It definitely does.
If technical analysts truly believe the efficient market hypothesis, the idea that the market is a perfectly efficient pricing machine that instantly bakes all data into the price, how can they possibly believe they can beat the market by looking at past price trends?
It sounds contradictory, doesn't it?
Totally. If the price is perfectly efficient today, there shouldn't be any predictable, exploitable trends for tomorrow.
That is a hotly debated paradox in finance, and honestly, it is exactly why fundamental analysts often mock technical analysts.
I can imagine.
The pure academic version of the efficient market hypothesis suggests you absolutely cannot beat the market because prices instantly reflect all known data. However, the technical analyst navigates this by focusing on human reaction.
Oh, human reaction.
Yeah, they concede the data is in the price, but they believe the crowd's reaction to that data happens in predictable waves. They aren't trying to outsmart the market on the true value of the business.
They're trying to outsmart the psychology of the herd.
Exactly. Riding the momentum of mass buying or mass selling.
It is like trying to guess what song is playing in a silent disco just by watching the way people are dancing.
Oh, that's good.
Like, you don't need to hear the actual music. You just read the rhythm and movements of the crowd to know exactly when the beat is going to drop.
That is a phenomenal way to visualize it. So now contrast that crowd watching with fundamental analysis.
Right.
Which is essentially putting on the headphones, pulling out the sheet music, and actually reading the notes.
Right.
Fundamental analysts flatly reject the idea that the market is always perfectly efficient in the short term. They believe the market is frequently irrational, creating this divergence between a stock's current trading price and its true intrinsic value.
So instead of looking at volume and price charts, how are fundamental analysts calculating that intrinsic value? What are they actually looking at?
They look at the actual gears of the business and the environment it operates in. The workbook outlines this top-down approach. They start with macroeconomic trends.
Hmm.
So how are interest rates, inflation, or government policies affecting consumer spending in this specific industry?
Getting the big picture first.
Right. Then they look at the intensity of competition. Is this company essentially a monopoly, or are they fighting a brutal price war with 10 other competitors?
So they're trying to figure out if the environment is hostile or friendly before they even look at the company itself.
Yes. And once they finally look at the company, they dive deep into the cost structures. How efficiently do they manufacture their product? Can they maintain their profit margins if the cost of raw materials suddenly spikes?
Really getting into the weeds.
Oh, deeply. And crucially, they evaluate the capabilities of the management team. Does the CEO have a track record of allocating capital wisely, or do they just burn cash on vanity projects?
So they take all of that.
The fundamental analyst takes all of this, projects the company's future cash flows, and calculates what the business is mathematically worth today. If the current market price is significantly lower than their calculated intrinsic value, they buy.
Okay, but if fundamental analysis is ultimately about finding a true mathematical value based on projected profits and costs, it begs a major question for me.
What's that?
Why involve human analysts at all? Like, why not just rely on cold, hard math? Feed all the historical data into a supercomputer and just let it spit out the intrinsic value.
Well, they try.
Yeah, the manual introduces quantitative research, which seems like the ultimate solution at first glance, but it actually outlines some severe limits to pure math.
Yeah, quantitative research is incredibly powerful, but it's rarely used in isolation for fundamental analysis.
Why not?
Well, analysts use these econometric approaches, complex time series, and regression models. To put it simply, a regression model takes a massive scatter plot of a company's past financial performance, revenue, margins, debt levels, and it draws a mathematical line of best fit through all that data.
Okay.
Then it extends that line into the future to predict next year's earnings.
Which sounds completely foolproof. I mean, math doesn't carry biases.
The math itself doesn't have biases, no. But the inputs are really fragile because the real world just refuses to stay static.
Right.
The primary limitation highlighted in the text is the availability of comparable information. Accounting standards change, right? Meaning the revenue reported in 2015 might be calculated totally differently than revenue in 2025. Furthermore, business models evolve drastically.
Oh, right. Think about a company that manufactured physical computer hardware a decade ago, but over the last 3 years, they completely pivoted to, like, a cloud-based software subscription model.
That is exactly the problem. If you run a pure quantitative regression model on their past 10 years of data, drawing that line into the future, the computer will spit out a highly precise forecast.
But it will be totally wrong.
Completely inaccurate, because the data from the hardware years is no longer comparable to the software years. The underlying physics of the company changed, rendering the historical math completely irrelevant. Pure quantitative models really struggle with context.
So the math breaks down because companies change. But the text introduces another layer, the behavioral approach, which suggests that even if the math were perfect, the market wouldn't care, because humans essentially ruin the models with emotion.
They absolutely do. The behavioral approach acknowledges a reality that pure mathematical models ignore. Investors are not perfectly rational calculating machines.
Far from it.
Right. Stock prices deviate violently from their fair mathematical values because of human psychology. Panic selling during a geopolitical crisis, or euphoric buying during a tech bubble. Fear and greed drive prices far away from the intrinsic value that the fundamental analysts so carefully calculated.
But wait, if we think about the mechanics of this, the very fact that humans are irrational, this whole behavioral approach, isn't that the exact engine that makes fundamental analysis possible in the first place?
How do you mean?
Well, if humans didn't panic or get greedy, the market would be perfectly efficient. There would be no mispriced stocks, no bargains, and the fundamental analysts would be out of a job.
You have pinpointed the beautiful irony at the heart of value investing.
Really?
Yes. The flaw in human rationality is the very feature that creates opportunity. When a temporary panic drives the stock of a fundamentally sound company into the ground, the quantitative model might show a broken trend.
And the technical chartist might see a massive sell signal.
Exactly. But the fundamental analyst sees human irrationality creating a massive discount.
The manual calls that the margin of safety, right?
Yes, the margin of safety is the gap between the actual intrinsic value of the company and the artificially low price created by market fear.
So if a company is truly worth $50 a share, but panic has driven the price down to $30.
That $20 gap is your margin of safety. It protects the investor if their calculations are slightly off, and it provides the upside when the market eventually returns to its senses.
Wow, it is just fascinating how much of this relies on human behavior, corporate management, and consumer trends. But the ultimate test for this behavioral theory is what happens when you remove the human element entirely.
Right, going back to the physical world.
Yeah, if human psychology and corporate decisions drive stock prices, how do you analyze an asset that doesn't have a CEO, a marketing team, or an earnings report? Chapter 4 takes this really sharp turn when it discusses the fundamental analysis of commodities.
Things like a barrel of crude oil, an ounce of gold, or a bushel of wheat. It requires a radical shift in the analyst's framework. When dealing with commodities, fundamental analysis strips away corporate governance entirely. You aren't analyzing profit margins or reading a CEO's letter to shareholders.
Because there isn't one.
Right. The analysis pivots away from the corporate world and focuses purely on the raw mechanics of supply and demand in the physical world.
Let's look at the mechanisms of that supply side. What is the data they are actually gathering to build that mosaic if they can't look at a balance sheet?
They look at physical constraints. For agricultural commodities, they analyze planted acreage, soil conditions, and crop yields.
Okay.
For energy, they look at drilling rate counts, pipeline capacity, refinery output. But the ultimate variables, the ones that cause the most massive price swings, are completely unpredictable natural events, like weather and geological disasters.
Which seems insane for a profession built on rigorous modeling. Instead of reading a quarterly report, the analyst is literally reading the weather forecast.
It sounds crazy, but yes.
Watching for a drought in the Midwest or a hurricane in the Gulf of Mexico. But how can you possibly build a reliable financial model when a random freeze in Brazil can destroy the global coffee supply chain overnight? Doesn't that reduce analysis to just like gambling on the weather?
Well, it would be gambling if the analysts were trying to predict the weather with certainty. But they aren't doing that.
What are they doing then?
They're modeling systemic vulnerability. To understand this, we have to look at the mechanism of inventory. Inventory acts as a global shock absorber. A commodity analyst closely tracks how much of a resource is currently sitting in storage warehouses globally.
Because the inventory is the buffer between supply and demand.
Precisely. If global wheat inventories are high, a drought in Australia might barely move the price, because buyers can just tap into the stored surplus. The system absorbs the shock.
Right, it doesn't matter as much.
But if an analyst sees that global inventories are at a 10-year low, they know the shock absorber is gone. In that scenario, even a minor weather event won't just move prices linearly. It will create a geometric, violent price spike because buyers will absolutely panic over a physical shortage.
Wow.
The analyst isn't predicting the storm. They are calculating exactly how vulnerable the market is to any disruption.
So they're measuring the tension on the rubber band, basically, waiting to see what snaps it.
That's a great way to put it.
Well, we have covered an immense amount of ground from this workbook today. We started by drawing a hard line between the fast-paced, spread-chasing world of trading and the rigorous, intrinsic, value-seeking nature of investing.
We did.
We broke down how analysts use mosaic theory, tracking those delivery trucks and job ads, to legally triangulate an informational edge without crossing the line into insider trading.
And we also explored the great philosophical divide in market analysis.
Oh, yeah, technical versus fundamental.
We looked at technical analysts who rely on the efficient market hypothesis and basically chart the psychological momentum of the crowd. And then we contrasted them with fundamental analysts who ignore all that noise to calculate the true mathematical worth of a business based on macroeconomics, cost structures, and management capability.
We saw how pure quantitative regression models, drawing that perfect mathematical line into the future, can catastrophically fail when a company's underlying business model evolves.
Yes, context is everything.
We explored how human emotion, the fear and greed outlined in behavioral finance, creates the very mispricing that allows for a margin of safety. And finally, we stripped away the corporate structure entirely to look at commodities, where supply and demand are dictated by global inventories and unpredictable weather.
It's a lot, But understanding these distinct frameworks is really what separates a passive observer from an informed participant.
Absolutely.
The next time you see a financial talking head on television aggressively pounding the table about a stock, you now have the tools to decode what game they are actually playing.
Right. Are they reading the historical momentum of a chart, or are they reading the long-term cash flow of a balance sheet?
Exactly. Are they looking for a 2-day technical bounce or a 10-year fundamental growth story? Recognizing the difference protects you from applying a trader's rules to an investor's portfolio.
It gives you the power to filter the noise and just ask the right questions. Which leaves me with a final thought to mull over for our listeners. We talked about how human analysts currently find their edge by exploiting the emotional, irrational mistakes of the crowd.
The margin of safety.
Right. But as algorithms grow exponentially more powerful, as artificial intelligence instantly processes satellite imagery of crop yields, global inventory data, and every corporate earnings report the exact second it's published, if the machines eventually master both quantitative and technical analysis perfectly, will understanding human irrationality, our deeply ingrained biases, our panics, and our euphorias be the only true edge left for the human investor. Something to think about the next time you feel the sudden urge to panic